I'll tell you what Santa didn't bring this year: any kind of good news for housing. All right, jokes aside, December was pretty quiet with some pretty predictable surprises. So without further ado, let's get right into this video. Okay, like we always do, first up are last month's sales. Last month, we only sold 1,277 homes. For the third month in a row, this was the worst month ever. Compared to December of the previous year, this was a 57% reduction in sales. Now, January is always the worst month of the year for sales, so it's reasonable to presume that this month's sales will mark the fourth month in a row of worst sales ever. All right. Since sales were horrendous, what effect did this have on the median sales price? As you can see on the screen now, for the seventh month in a row, the median price has declined down to only $420,000. This now puts us $65,000 below the high set back in May. In other terms, the median price has come down just over 13% in 7 months. Next up, let's check out the current inventory levels. We ended the year with only 6,532 homes on the market. This also marks 9 straight weeks of inventory decline. Ironically, this is close to where we were in December of 2019, before the entire world stopped making any damn sense. Now, remember this part for later when I spend some time discussing this particular metric. Okay, last but not least, let's check out housing absorption by price range. We look at this metric to see how competitive individual price ranges are performing. The higher the percentage, the more competitive it is. First up are homes priced between $250,000 to $500,000. This comprises the vast majority of our entire market. We went from 22% absorption to 24%. Next up are homes priced between $500,000 to $750,000. This actually decreased from 18% to 17%. Next are homes priced from $750,000 to $1 million. This remained stagnant at 15%. Now we have $1 million to $1.5 million. This actually increased from 15% to 17%. And last but not least, we have the ultra luxury market of over $1.5 million. This increased as well from 11% to 13%. Overall, the entire market increased from 20% to 21%, meaning 1 out of 5 homes are currently under contract. Now, you compare this to March, when 2 out of 3 homes were under contract, and well, you get the big picture. Now, before we make sense out of all this madness, I want to discuss this for a brief moment. This is one of those times where statistics only show a real foggy depiction of reality. Take that $750,000 to $1 million price range. From the very beginning, I saw this as a real troublesome price point. Well, while the percentage remained the same from last month, there's only 92 homes in the entire Las Vegas Valley under contract. 92 homes. The only reason the percentage remained the same is because the overall inventory levels have plummeted as well. When you look at the entire market as a whole, while the saturation levels went up by 1%, there's also 163 less homes under contract right now than there was last month. So let's unpack some of this and try to make some sense out of this madness. Sales are dismal, and frankly, I think they'll continue to be weak until rates fall and or prices come down between 20 to 25%. Of the homes that I'm seeing selling, they're either well-appointed and highly desirable, single story, or priced, say, 20% below what their high was. I'm still seeing substantially more neighborhoods with no sales and nothing under contract than we should. Some neighborhoods are down 20% and they're actually now moving. The rest are just sitting stagnant. Eventually, these sellers are going to break and start lowering their list prices. Now, sadly, I thought this was going to happen during the holiday season, but there seems to be more holdouts than everyone anticipated. The key to much of this has to do with inventory levels. Now, inventory typically doesn't pick up until mid-March. At only 6,500 homes on the market right now, this is typically only a 2-month supply of inventory. Because sales are so dismal currently, it actually equates to about a 5-month supply of inventory. Now, as I've been saying for a year now, this is nothing like last time. People simply don't need to sell like they did before. Investors who own small homes with great cap rates, it makes no sense for them to sell. Most owner-occupied properties aren't worth selling with 3% mortgages attached, only to repurchase at 7%. I dedicated an entire video back in November that explains this theory and depicts how the market will eventually turn around. So check that one out if you missed it. Now, in the meantime, you can expect prices to continue to decline until rates hit around 5%, or we see a 20+% decline in value. Now, at the rate we're going, 20% should be around mid-spring. But let's keep a vigilant eye on these inventory levels, okay? Nothing remains static. Eventually, investors will jump back in, and once investors jump, so will every buyer who's been sitting on the sidelines for a year. With only a 2-month supply of normal inventory, whenever this rebound does happen, it's likely to be really fast and brutal once again. And let's not forget, this isn't just a Las Vegas issue. Lack of housing has become a national issue. And the more hedge funds and corporations purchase rentals, the more constrained our inventory will become, since these homes no longer come back on the market every 5 or so years. Which makes me think, would you guys like me to do a video on corporate-owned rental properties and the effect it's having on affordable housing? If so, please leave your comments below. I'd like to hear what you think. Well, that's it for this month, everyone. Thanks for watching. Please help me out by liking this video and clicking on the subscribe button. Have a great start to 23, and I'll see you guys all in the next one. Deuces.